Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, I'm speaking with John Hardy, Chief Macro Strategist at Saxo Bank. Every year for at least the last 2 decades, Saxo Bank has released their annual outrageous predictions list. And today's guest, John Hardy, has been involved in those predictions since the list began. Is that right, John?
Since the list began, the year after the list began, I believe.
The year after the list began. Okay.
But close enough.
You've got big shoes to fill here because we normally talk to Steen Jacobson about this, and he is now retired, I believe.
Yes.
So we'll try and get Steen on another time for a retirement debrief. But for now, you're the guy. You're going to have to fill his shoes. Thanks so much for joining us today.
I'll do my best. Thank you. I'm glad to be here.
I have a feeling you're going to do pretty well. I have a list of these outrageous predictions in front of me, and we're not going to talk about all of them because listeners can go to your website, right, and have a look at them, the ones we don't talk about today.
Sure.
Yeah. So,
Great.
If you want to hear more about this, listeners, go look at the website and you can see the ones we don't talk about today. But we're going to get through quite a lot of them because they are relatively outrageous. So the first one, and I'm not going to do them in chronological order, but the first one is Trump 2.0 blows up the US dollar. What's going to happen?
Well, again, these are outrageous predictions. They're not our forecasts for the future. This is not our sort of baseline outlook for what is going to happen. But John,
before you take it any further,
Yeah.
if any of these things happen, you're going to call them forecasts, not outrageous predictions, aren't you? If this actually happens, next time we talk about it, you're going to say, as I forecast.
Well, no, I don't think so because they rarely come true, but occasionally they do. And that's the idea here, is to take some very serious issues that we see in the background, whether it's geopolitical, financial markets, or otherwise, and say there's pressing things going on. Maybe there's a lot of consensus in this case that Trump 2.0 actually should mean a strong dollar. Mm-hmm. And what we're saying is maybe we have this wrong. There are ways that we could actually see this resulting in a much weaker dollar. That means blows up, meaning, of course, it goes down, not that it goes up or inflates, that it goes down the U.S. dollar.
Okay, so what's the mechanism?
Yeah, well, the mechanism could be from just about any direction, but one of those is the sort of post-Plaza Accord reality that we have economies now needing to act more in their self-interest. A multipolar world, no longer the sort of global landscape of the U.S. Hegemony rules all into one global reserve currency to rule them all. But we have multiple currencies and multiple regions acting more in their self-interest. And this has really been brought about from the U.S. side because the global reserve dollar as the global reserve currency is just not working for the U.S. economy anymore. And so we have a much more self-interested U.S. Nationalist economics, if you want to call it, the threat of tariffs, et cetera. And almost a weaponization, and really it is a weaponization of the U.S. dollar for those that don't want to play ball. And therefore, major trading partners, major powers in the world outside of the U.S. will be seeking alternatives. And they already are to a degree, but this will be something that could really pick up pace in 2025.
I mean, this has been discussed for so long that there's going to be an alternative to the US dollar, that everyone's had it with always having to trade in dollars, and they're going to start trading in various different currencies. The BRICS are going to create their own, joint trading bloc, etc. These things this conversation has been around for ages, but there is the idea here is there's a possibility that it is Trump's tariffs that could actually make it happen.
Yeah, and it's kind of interesting. You see almost some foreshadowing of this when you have Trump saying, "Well, if the BRICS countries are going to seek to trade outside of the U.S. dollar, we're going to slap 100% tariffs on all of them." Well, it almost becomes a self-fulfilling conclusion if that is going to be the future of trade relationships. This kind of tit for tat measure. So it's not a trivial thing to do, to create a new currency. And of course, the dollar's days are not done, but it's a matter of degrees and a matter of perhaps rolling over and something new starting rather than that this is something that's going to happen overnight. Yeah. So I don't want to give the impression, even as an outrageous prediction that we're talking about some kind of sudden end to the U.S. dollar. It's about new potential currencies and ways to trade coming about.
Yeah, but then there's a fascinating little bit in the middle of the summary of this where it says, while slashing deficits with the help of an Elon Musk-run Department of Government Efficiency or DOGE, and that implication that really is possible.
Well, it's possible, certainly possible in theory. There's plenty of government bloat that could be attacked, but of course there are also political constituents that would not be happy to see their funding pulled. And I don't think we even necessarily need to see that to get a weaker dollar. But we have to remember that a weak fiscal impulse is also very negative for a U.S. dollar. So even if we don't go the route of the dollar weakening because they inflate further deficits, and the Fed has to do some sort of new QE or something to keep the U.S. Treasury market, from seizing up. If we have the Doge suddenly coming in a big way and cutting spending, that's also quite negative for the U.S. dollar, also a negative for U.S. growth.
Yeah, and partly to do with this falling supply of U.S. dollars.
Yes.
Yes. Okay, now let's go on to the potential market impact. Actually, I've got to say it sounds pretty good. The crypto market quadruples to more than $10 trillion. And I think probably by crypto, we're really talking about Bitcoin, or are we talking about all types of crypto?
It was just the crypto market in general. We don't like to talk specifics when we talk crypto. It's just not an area we like to make a big profile or cut a big profile in the market.
Okay,
so it's just a general idea that one of these alternatives could be the crypto space, and read that as you will.
Interesting. You'll definitely get hate mail because almost everybody else who comes on this podcast likes to divide crypto into Bitcoin, which is real, and crypto, which they consider to be less real. So I'll forward your hate mail direct to you.
Thanks
and then it
much.
says the US dollar falls 20% against major currencies and 30% versus gold. The US economy continues to reflate, but wages keep up with goods inflation as production resources reshore to the US. US exporters advantaged. I mean, it sounds great.
Yeah.
Sounds great for the US.
It does sound good for the U.S., except there will be inflation. I think the key for this to be something that the U.S. can pull off, and there's so many ifs involved here, would be potentially sort of selective inflation. I mean, the U.S. is very well supplied in terms of energy from its own resources, from food. So if they're able to keep those key categories down, cost of living categories down in reasonable inflation levels relative to wages in particular, and people don't feel like they're getting poorer from paycheck to paycheck, I think the U.S. public could potentially not be too upset if some consumer goods, namely those produced in China and elsewhere, are suddenly seeing much higher rates of inflation than those other cost of living related goods.
Yeah, well, people don't mind inflation as long as their real income remains the same or rises, right?
Real income in what categories is the sort of the nuance I'm trying to introduce there. But yes, in general, yes.
Okay. Well, we touched on energy, so let's go straight on to another outrageous prediction. Electrification boom ends OPEC. Now, this is about electrical vehicles. As electrical vehicles become more affordable, could oil-rich OPEC become irrelevant in 2025 and find itself on the ash heap of history? Now, this comes at a time when all of our newspapers are full of stories about how nobody wants an EV and the manufacturers can't sell enough EVs, and there's all this worry about whether we can really phase out petrol and diesel cars and whether it's really possible for the government to continue to fine manufacturers for not selling enough EVs, etc. So the general mood at the moment, certainly in the UK, is really, really anti-EV.
In the UK, yes. And in the UK, you also have a terrible infrastructure for charging EVs. And that is the key challenge with EVs. I think the EVs themselves have gotten to incredible levels of range, and the efficiency of an EV is quite remarkable because it's so much better an energy source to use electricity rather than fossil fuels, because you're getting so much waste heat with fossil fuels relative to the efficiency of to the kinetic needs to turn wheels with an electric motor. So for those countries where they build out the infrastructure, the transition can be quicker. If you look at Norway, et cetera. But I think the key point here is one of rate of change. And one of the biggest markets is China, where already they're going beyond 50% EVs now in terms of the new passenger vehicle mix. At some point, the Tesla Semi or other companies would be making for hauling goods, so transport vehicles as well as passenger vehicles. And we're just talking about at some point, possibly within a year, possibly 2 or 3, we're at peak oil in terms of the demand side. Not that there's some kind of absolute geological limit that we've reached, but we're at a demand peak. And what does the exponential decline curve look like? And if your country is reliant on oil exports, do you break ranks, produce more now rather than later, perhaps make a long-term supply deal with somebody else? It's not so much about OPEC, really, which is in the text. To me, this is more about the thought process around peak oil demand and electrification and what does it mean.
Yeah, I find this one really interesting because it's one of those ones that I think it would genuinely be one of those things that is is very, very unexpected, in that I think a lot of people who don't look very carefully at the energy market might think, well, that sounds entirely reasonable. That could easily happen. That's what I expect to happen. But in fact, of course, we know that even as demand for electricity rises at the moment, so does the demand for fossil fuels. So we're still seeing rising demand for fossil fuels globally, and 80% of energy used globally remains fossil fueled. And even in Scandinavian countries where, I think it is it Norway, where the majority of new cars sold are now EVs, but nonetheless, more than 80% of the cars on the road remain combustion engine cars.
About 75%.
75%.
But although 90% now are EVs of new cars sold
in
Norway,
EVs,
and it's a very small country. But you're right, and you do have to get into not just passenger vehicles but other vehicles. And it does take many years for the replacement to fully happen. But once those EVs become more attractive to own and they're easy to charge, perhaps the replacement accelerates. This is outrageous, right? But we need to consider, what does this look like in terms of a handful of years when there's a process change and a mentality change for those that are exporting oil, especially when you have a U.S. that has created essentially two Saudi Arabias of oil production, and first in the shale gas patch and then in the shale oil patch. And it really is important to differentiate here on talking oil. We know that gas is still growing, and the supplies will probably grow for at least another decade, or not, if not more. So it really is the oil side of things that we're talking about. Oil, and specifically used for transport, is its biggest current use.
So it's interesting. I mean, you could have had another outrageous prediction on a similar vein, suggesting that the price of oil was going to collapse because the supply of oil coming out of the U.S. under Trump 2.0 would be so high.
I think that's less likely because a lot of the new production that's been brought online is in U.S. shale, and it's much easier by the nature of U.S. shale, many small fields, many small sources to turn up and turn down production versus the large field model where that's not really feasible to so quickly and dynamically change the production rates. So, without being an oil industry expert, I think we do have a very different structure to how the supply and demand, how supply can respond to demand and price relative to previous regime.
Okay, well, this, again, if you actually get down to read your bit at the bottom on potential market impact, sounds great. Absolutely great. Crude oil slumps in price. It's a boon for airlines. We all get to travel more. Luxury travel booms, right? Chemical, paint, and tire manufacturers, freight and logistics companies, they all boom too. This sounds amazing. The market balances out quickly. Oil prices stabilize. Again, that's good. Higher cost suppliers, particularly in North America, shut down expensive shale oil production. People won't complain about that too much, will they? And the only people who end up in a bad way are the Japanese car manufacturers, who find themselves in a desperate race to catch up with some other EV players. Will anybody else suffer badly from this? This is almost entirely good news.
Well, some of the OPEC countries themselves.
Oh,
perhaps,
the OPEC countries, of course, I'd slightly forgotten about the big one.
Those
yes,
that are too reliant on their oil revenues for their national income. And you kind
but they're all aware of that, right?
Yes,
all those OPEC countries, they've all
right
been trying to diversify, move into different areas, and we see that across the Middle East, for example.
We're just talking about bringing the awareness forward to this is happening sort of now in the coming few years. It's not just about a 30-year generation forward effort. This is a process that starts more or less now.
Well, maybe. Okay. It's not, you're not expecting it to happen. You're thinking there's a chance it might happen. Okay, so we're going to stick with energy. So we've just discussed one outrageous prediction being that oil becomes very cheap. And so one type of energy becomes extremely cheap. Then we move along to the next outrageous prediction, and it's the US imposes AI data center tax as power prices run wild. Now, I thought this one was really interesting because I noted it, about 8-9 months ago, maybe a bit longer. The EU started discussing taxing AI in order to prevent it using so much energy. Yeah, do you remember that?
I do remember that, and you also saw a microcosm here and there with the Bitcoin mining, the type of energy resources or electricity resources that requires. So this could be an issue when we're talking about the acceleration and build out of these AI data centers. Now, of course, if you're particularly large, you're going to need to find the agreement to hook up to the grid somewhere anyway before you can even get started. But at the same time, the AI-linked demand is growing, and you're seeing the likes of a Microsoft wanting to restart an old nuclear reactor in the U.S., 3 Mile Island, to get resources for a data center there. You see the Amazons, Googles, Oracles of the world talking small modular reactors with nuclear powered.
Very keen on those in this podcast.
Super interesting. But what about between now and year 5-6 when that thing is done, right? You have this that 5 to 6 years of growth, and some are saying,
well, can't the Koreans build them very quickly?
Still think we're talking a few years before something is available in size to power these things. And if the calculation requirements, there's one estimate is it doubles every 100 days. That's a lot of doublings per times X number of 100 days. Where's the energy going to come from? I think it's interesting to think if this demand does grow at that pace, it's going to start, that baseload requirement is going to start interacting with peak requirements for households and basic industries. And there'll be a conflict there. And it could mean that we actually, and it's to remind people in general, we still live in a world with physical limits. Maybe in the days of Starship and SpaceX, we think we don't, but there are some physical limits that could get a bit more pressing with links to AI.
Yeah, and you write here, this inspires popular outrage as households see their utility bills skyrocket, aggravated by the huge spikes in power prices for electricity consumed at home during peak load periods in the evening. So this is in the US, right, where we expect they'll get absolutely furious if their utility bills go up. And here we are in the UK. We just sit here watching them go up and up and up and up. We're not out on the streets. What's wrong with us?
Well, there's some specific challenges that were from 2022 that happened in the UK, and plus the transfer of the energy system here of some partially reliable and renewable energy, and that's
really
how do you
expensive.
buffer it? Where's the base load? These issues are plaguing at times when the wind doesn't blow or the sun doesn't shine enough. You don't have the storage out there to power when those energy resources are down or not producing at the capacity you need.
Yeah. Okay. So again, this could be good news, right? So you write again down to your potential market impact, and here this looks like unmitigated good news. You're such an optimist,
well,
aren't you?
Not for those that are investing in AI if they're held back from
But they won't be held
developing the
back for
models.
long. A massive boom in U.S. investment in power infrastructure. Companies like Fluor, is that how I said? I don't know.
Fluor, yeah.
Fluor. Rise on signing massive new construction deals. Tesla is accelerating. Megapack gets increasing attention. Long-term U.S. natural gas prices more than double. Then we get a bit of inflation.
Yeah. If you look at U.S. natural gas prices specifically, they've been so absurdly cheap for so long because the shale patch in the U.S. has delivered at incredible rates, and they've capped the ability to export it. So just a realistic market price for natural gas that's still cheap is double what it is now. In the U.S. It's also to point out the natural gas pricing around the world is not flat. It's very, very, very differentiated depending on where you live because it's a difficult product to ship. It has to be liquefied, and that's very energy and cost intensive to do so, and then shipped around the world in these incredibly expensive, very high tech ships.
Yeah. Well, the one very good thing that could come out of this, because we know that the people running AI data centers or setting them up, except all these companies, big tech companies, they've got huge amounts of money. And if they really want cheap energy fast, they may well push forward what we were just talking about, the development of SMRs that can be put up in a hurry and used very efficiently.
Absolutely, yeah.
I mean, they could really accelerate these. And that would be amazing, for example, for the UK, because we could stop with all the ridiculous offshore wind and all that expensive stuff and the solar that hardly ever works. And we could just stick up SMRs around cities all around the country. Problem solved.
Yes, let's do it, but let's see how easy and cheap that is. It sounds so easy, but it takes many years, and the designs are still in design phase. There are some designs that are complete, but these things are not available in large numbers yet.
I get that, but as we often say on this podcast, if anyone can do it, the tech bros can. So if they're under pressure, it may happen faster than it might have otherwise. Okay, that's a good one. Before I choose more, you must have a favorite.
Well, we already covered my favorite, which was the Trump 2.0 blows up the U.S. dollar. When the consensus is one way, and you want to be outrageous by saying, well, what about this? Or what about if this doesn't turn out the way you expect? And expecting a strong dollar is having your cake and eating it too, and the other consequences we talked about. So, yeah.
All right. Okay, let's move on to Nvidia then. Nvidia balloons to twice the value of Apple. Now, here's the thing. It's kind of outrageous to people who look at stock market history to think that any stock could keep growing like that and could become so big, etc. But if you look at, for example, in the UK, at the top buy lists of retail investors, any of the platforms, Nvidia is always up there at the top. There's a lot of people out there who are expecting this, who don't think this is outrageous at all, who think this is exactly what should happen. It's been going up for ages. It's going to go up more. That's just life.
I agree and I disagree. So, of course, 100% stock market performance or stock performance on a 12-month basis is a very strong performance indeed, but it did a lot more than that last year, right? So what's so big about 100%? Well, it's talking about sheer magnitude. We're talking about a $3.5 trillion, if it's going to double in size, $3 to $3.5 trillion of market cap created. That's, for perspective, maybe slightly less than the entire UK stock market is worth, almost twice that the DAX 40 is worth. So we're talking big numbers here in short. And you're talking about a company, as you pointed to, growing at incredible rates, could become the most profitable company within 12 months, at least within 15 months or 18 months, doing that at incredible growth rates. Whereas you take an Apple, currently the most profitable company ever, it's grown 10, 12% over the last 3 years. And that means not yearly, that means in total, top line. So it's just for perspective, yes, it's a richly valued company, and yes, it requires that growth. What are the implications? The other side of it, and this is a small point to this, and I think an important one, though, is that if Nvidia, and these are simply based on projected earnings for the company going forward, if it is to earn that much money and get that much revenue, who is providing that revenue? This is the other Mag 7 stocks largely, who are building these gigantic data centers. So that becomes a headwind to their profitability because they're having to make these huge investments that aren't yet paying off in terms of the end uses of AI. So we have this AI arms race to get these data centers built, to find these applications, but those applications aren't yet paying the dividends, and therefore just a higher cost structure for these formerly and still really very, very, very profitable companies.
Okay. So then back to the end game for this, the potential market impact. Nvidia shares trade well north of $250. And then there is a suggestion that later on, the market and the regulatory authorities start to look at that and go, whoa, hang on, that's got to be quite some monopoly. And then you get the regulatory scrutiny that might bring it to an end.
As well as I think implicitly that these growth rates can only be achieved for so long because the size becomes so enormous. You're talking about sucking up the profits of the entire economy at some point, right? With when a company has gotten to this magnitude.
Yeah, but then you might get a wonderful moment, because I'm assuming that pretty much all Americans by now own a couple of Nvidia shares. You might get a moment when you have an amazing wealth effect from these share price going quite that high. Great for American consumption. Here they are with their budget being slashed, their cheap energy, their hundreds of thousands of dollars each from their stake in Nvidia.
Well, the cheaper dollar as well, so it buys less on the world stage. But just to put a wrench in the argument, if I can, but yes, there is a wealth effect, but the wealth effect is less in equities than something like income paid out from bonds, for example. That goes straight into spending when you get your coupons, whereas the wealth effect is much more muted from your share portfolio going up. But yes, there is a positive wealth effect.
Okay. And on the other side, what would crash Nvidia? I mean, to many people, it would be just as outrageous to say Nvidia is going to $1.
I'm not so sure it's outrageous to say NVIDIA is going to fall. It seems like there's a lot of folks that recognize that the incredible ascent of this company, and there are plenty of naysayers. Not so much that it's not a good company or doesn't have an amazing AI platform, that the Blackwell chip there's anything amiss with it, but just that these growth rates are just not possible extended too far out into time. And somebody is right, or they are right at some point. But the question is always one in investing and especially trading of when. When are you right? When does the growth curve stop going exponential? When is it? When do they have a bad miss, for example? And suddenly you have to look forward to a no growth next year in chips, or even a 10% fall versus what you've been used to as 200% originally, and now 100% growth in these sales on a year-on-year basis, et cetera.
Realistically, that's more likely, isn't it?
Eventually, but again, timing.
Okay, all right, China. No one's been investing in China for ages. Looks a little uninvestable. Your summary here, having created China's most epic debt bubble, China boldly prints to try and make it all okay. I'm summarizing.
That's just kind of a fair assessment of the outrageous prediction. But I think our point here is one. It's not so much about the magnitude. Yes, if they printed 50 trillion UN in a reflationary move, this would be larger than anything they've done before. That's about 7 trillion US dollars, by the way, for perspective. It's more about China needs to move away from its economic model that was based purely on fixed asset investment, and especially the real estate bubble and debacle, and dealing with all the debt that is linked to that. So they need to power through this balance sheet recession, which has echoes of Japan's experience starting in the late 80s. And it's about fiscal. It's about getting money into consumers' hand and rebalancing the economy more towards consumption. Could they start to look at producing or creating a better social safety net? They have a long-term demographic crisis that needs to be addressed. A social safety net might go a long way to having more people feeling comfortable about starting families, getting married, etc. these are long-term social issues that China may look at. It's kind of linking to a change of behavior and something, a new China relative to just the size, pure size of the stimulus.
And again, this is something that's been discussed for years.
A very long time.
How can
Yes.
China do this?
Yeah.
How can they move towards a more consumption-orientated economy? How can they make people spend? And there's one rather lovely idea in this, a proper kind of people's QE, whereby you use a digital currency to put money directly into people's accounts.
And they have the technology to do that, and they've experimented with it, but they're most likely being held back by concerns about inflation. And so there has to be, of course, some balance in there in the size of the stimulus relative to the type of inflation it would cause and risks from that.
And if you have the technology to do that, to put money directly into people's pockets via a digital currency, presumably you also have the power to take it right out again under, for example, a social credit system or anything like that.
Or or to turn it off. You start it and then you turn it off if it's causing problems. And we saw this. I mean, the clever thing about the digital approach is you know exactly who it's going to, whereas in the case of the pandemic response, it was just showering endless amounts everywhere because you didn't know exactly what the transmission or how good the transmission would be. And there was a lot of fraud involved in the U.S. case.
Yeah,
and the digital trail, of course, Big Brother, et cetera, your concerns about that, but at least you know more precisely who it is going to and the transmission mechanism.
Okay, and the market impact here? Got to be good, right?
Well, it should be good. It should be good for global growth, for global nominal growth. It should also mean higher global inflation. China would be competing for goods relative to the rest of the world. Yeah, there's but more just a transformation of China's economic model has huge consequences. It becomes a big end market for consumption, which we saw at times for key companies, German auto manufacturers, for example, other companies as well. They were selling into China. Some of those are now pulling out. But can this process be stopped and turned around? I don't know. But somebody would need to satisfy that demand, obviously, if it was created.
So now we have this sort of rather marvelous situation whereby manufacturing is reshored to America. The Americans make a pile of stuff and sell it back to the Chinese.
There you go. Let's see if it can. let's see if it can happen.
That's exactly what President Trump wants.
Yeah, exactly what he wants. But will he get it, or are we headed towards more some kind of disentanglement, disengagement, divorce of Chimerica, as some call it? Yes. It's a huge existential question for how the global economy works in coming years. And we tried to kind of touch on that in this publication with a couple of these predictions. Okay,
I want to cover one last one, which is my favorite. We talked about your favorite,
there you go.
This is my favorite. I hovered here between the artificial heart and the pound, but I've settled on the pound. Okay. As Europe's economy struggles, fresh fiscal policy winds are blowing in the UK, driving sterling back to levels versus the euro not seen since before Brexit. The UK outlook is as constructive as ever in the post-Brexit era. That sounds like a very sort of damn with faint praise.
I didn't want to be too effusive in my praise. There are, this new budget, for example, from the Labour government, sort of takes things in the right direction, right in inverted commas, because it's focusing a bit less on things like subsidizing consumption. So things like the winter fuel, we can talk about inequality and issues with folks having the ability to pay for their heating bills, but it's not productive in a pure economic sense relative to encouraging investment in particular, and then raising the incomes of public sector workers. So that keeps the nominal economy humming along to a degree, which will help on the revenue side down the road. It also helps on the Bank of England not having to or being able to cut rates as much. So it just keeps the UK economy humming along
but
a bit more.
But it was a terrible budget for business. I don't know, to interrupt your optimism there, but, you can't talk to a business these days without being told.
It was not effusive optimism. I'm trying to...
They're, desperately trying to find a way to cut costs and cutting staff, and there's a horrible realization that maybe enough modeling wasn't done on cutting the threshold for employers' NI, and that may have very, very unpleasant consequences. So I'm going to go with you on the optimism, but an
equal degree.
I think it might be at a low TT.
This, to an equal degree on this prediction, was the negativity around Europe. And we see that right now in the headlines constantly. And when we wrote these predictions, we didn't know that Germany's government was going to fail. That happened shortly afterward. And we are going to have new elections in February. And we do see the opposition making very different noises on fiscal in a very cautious German kind of way, talking about ways that they can look to avoid the imposition of the debt brake or Schuldenbremsen, to stop the ability to expand fiscal, which is desperately needed in Germany, which has had its economic model disrupted by the end of cheap Russian energy inputs, and now China become a global competitor for some of its key traditional exports. So there's that, and there's France, where we can see the political dysfunction there. The Barnier austerity, the terrible budget that would have really just killed the French economy. What looks like it will be avoided because Le Pen wants to take down that government, but some big problems and questions at the heart of Europe are equally dragging on the Europe as much as we're sort of lukewarm, slightly positive on the pound. And it's also, again, it's this sort of, pushing back a little bit with the outrageous prediction against the quote unquote common knowledge that Brexit has only been a disaster and was only going to ever be negative for the pound.
Oh, you don't hear that on this
just
podcast.
fall.
Don't hear that here. Right. And the result here, encouraging domestic investment and a more robust growth outlook, supports sterling versus the flailing euro, seeing the euro sterling rate fall as low as 0.75, below the rate the day before the Brexit vote. As a result, the UK FTSE 100 posts a strong performance. So that's great. Here we've got a stronger economy than Europe. Who can argue with that? A rising stock market, a strong pound. We're all going on holiday, aren't we?
That sounds great.
It does sound great. Of all of these, I know you've got your favorite, the US dollar. But and I know they're all supposed to be outrageous, which do you think is most likely? If you had to hang your hat on one of them for next year.
I would actually still go with my favorite, which is Trump.
Oh, would you?
Yeah, Trump blows up the US dollar.
Okay, but it's still not the most likely scenario. So what do you think will actually happen next year?
I think we could see a stronger dollar for a while.
Mm-hmm.
The list of factors that could drive the dollar weaker are slower to come in than would be in the timeline of a 2025 prediction, and that the dollar actually stays volatile but relatively strong. It would be a forecast that I would, if I was asked to pen my forecast, that would be it for the coming year. But it will depend on so many things and I think the cone of uncertainty is particularly wide because you have a Trump 2.0. You have forceful policy measures relative to if you did not have Trump 2.0 coming into office with both houses of Congress, if very narrowly so in the case of the House, and the uncertainties around how China responds, how Europe respond, what's going to happen, Ukraine, Russia, war, all these factors. There are a heck of a lot of uncertainties in this world as we head into 2025. So I almost can't imagine anything but it becomes a rather outrageous year, probably in many ways that are absolutely not at all on our map and in our set of predictions.
Are you stocking up on gold and Bitcoin?
Gold is just a nice to have portion of your portfolio for retention of value. It's not a speculative asset that one should expect to go up by leaps and bounds. If you're expecting gold to go up by leaps and bounds, I really don't want to see what's happening to the world at that point in time. And when I say leaps and bounds, I'm talking about multiples.
Yes.
Then you're talking about some kind of hyperinflationary scenario, which is really sort of beyond the pale, even of outrageous, I would say, to expect that.
Yeah. And Bitcoin slightly feels that if Nvidia is going to the moon, so should Bitcoin.
We don't really do forecasts on Bitcoin. We try to keep it very generic in that space, just as a rule.
You really don't want the hate mail, do you?
I'll leave it to you.
Leave it to me. Thank you. John, thank you so much for joining us today in our London studio. Much appreciated.
It's been my pleasure. Thanks so much.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to your podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sam Asadi. Production support by Moses Andam. Special thanks to John Hardy. Thank you, John. Want to listen to episodes of Merryn Talks Money ad-free? Become a Bloomberg.com subscriber today. Check out our special intro offer right now at Bloomberg.com/podcast offer. Or click on the link in the show notes. You'll also unlock deep reporting, data, and analysis from reporters around the world. If you're already a Bloomberg.com subscriber, connect your account within Apple Podcasts to listen to this episode ad-free.